All right, in today's video, we're going to talk about investing hack number 5, and that is concentration over diversification. So one of the things that's very commonly accepted in investing is the idea that you should be diversified. You need to have a diversified portfolio that hardly moves because you just need it for safety and you don't ever want to lose money. You don't ever want to see your stock portfolio going down drastically. So you must be invested in the S&P 500 that has a little tiny sliver of all your money in 500 different stocks or more. Maybe you should have the S&P 500 as part of your portfolio and then diversify even from that. And I think back to when I was investing in a 401k at one of my jobs, they recommended not only having an index fund that did the total stock market, but then you also need another ETF that would diversify into other markets, stocks that were in other countries globally, so that you had some exposure over there, so that you're diversified around the world. Now, those ideas sound good to people that don't know anything about the stock market, and they may sound good to you. They sounded good to me at one point. I mean, I just told you, I was invested in that kind of stuff back when I was investing in my 401k at work and that kind of thing. But in investing, like in so many other things in life, there are different strategies based on what you're doing. And that is a great principle to adhere to in wealth preservation mode. So if you have your millions that you're going to retire on and you want to make sure that you don't lose a lot in a crash and that you're not volatile, that's a great strategy. Spread out to a lot of different holdings. But that's the wrong strategy for most of us because we're trying to grow our wealth. We're trying to compound our wealth and we're trying to grow that nest egg as quickly as we can. And to do that, we want to actually pick the winners. We want to actually focus as much of our capital on the companies that we believe are going to have outsized returns, above average, outstanding returns and growth over the years that we're investing in. And that's exactly why Warren Buffett, one of the greatest investors of the past 100 years, has consistently define diversification as a protection against ignorance, as a great defense against ignorance. And so if you don't want to know anything about your investments and you just want to play it safe, sure, you can pile all kinds of money into a very, very diversified portfolio and you should do just fine. But just remember, you're not going to get the kind of returns that people get excited about. You're going to have to pile a lot of money into that investment. If you enjoy learning about companies and investing in particular stocks, then you want to be more focused. How focused? Well, that depends on how convicted you are about particular stocks, and it depends on your strategy. And really, honestly, it depends on the stage of life that you're in, the stage of investing that you're in. So for my teenagers who are just beginning their investing journey, it makes total sense. They don't have that much capital and they're just beginning their journey. It makes total sense for them to pick one or two or maybe three different companies that they really like, that they really believe in, and they do some research on, and then they invest in those. But over time, it would make sense that as they age and as they accumulate more wealth, that they would want to choose other companies and expand that number. But what's the right number for you? It really just depends. And unfortunately, you're going to have to discover that for yourself. Just know that the more concentrated you are, the more meaningful your choices become. So when you're right, it really, really helps your portfolio. Or when you make a mistake and you make a bad decision, it's going to really impact it in a negative way. For myself, I've fluctuated between about 35 different stocks to, at this point, I'm down around 10. And I really like how focused my portfolio is at 10. I didn't think early on that I would feel comfortable with only having 10 different stocks, but I do. And I could see myself gradually building that up over time to include more, but I think 10, 12, 15 is the right spot for me at this stage in my investing journey. But the hack here, the strategy, the tip that you're going for is realizing that when you look down at the bottom of your portfolio at the smallest positions, you should be asking yourself all the time, is this worth my capital? Should I really have this last one? Or would my portfolio do better over the next year, 5 years, 10 years, if I take that capital and I allocate it to one of the higher stocks in the list, one of the stocks that's listed at a bigger position in my portfolio? Now, I get a lot of my investing mindset and principles and experience and strategies from other financial YouTubers. But in this particular case, the person that really changed my mind, made me think about it differently, was Mark Cuban. Now, if you don't know Mark Cuban, he's a famous billionaire investor who is on Shark Tank. You know, the guy who owns the Dallas Mavericks. And he made his wealth through building businesses and selling businesses and growing businesses and investing in other businesses. And one of the tips and one of the strategies that he talks about that really just bucks against this idea of diversification. I've tried to find the video, and I'll probably try a little bit more. If I can find it, I'll put a link in the description. But I remember specifically a video where he talks about, he's being interviewed, and he talks about the idea that when you're just beginning, you should go as focused as you can. And many people would consider that foolish advice, right? The interviewer was kind of surprised and saying, are you talking about if they're investing in Bitcoin or investing in stocks or investing in a company? And he was saying across the board, when you're just starting out, and this was his example as I remember, it might not be word for word, but he said, if you're just starting out and you have $500 and you're a young person, why not invest all $500 in the thing you believe is going to have the best return, that has the most potential? And if you lose it, well, at the end of the day, it stinks, okay? It's all the money that you had, but it's $500. Like, you'll replace that soon, and you'll learn something along the way. But if you're successful, let's say that particular investment doubles over the next year, that's meaningful. If you take that $500 and you invest it across the S&P 500, well, you'll make a little bit most of the time, most years, but it's not going to really move the needle. And so his advice was, in the early stages, take huge risks, even take the really risky risks, because early on you're not investing with so much that you can't afford to replace it. And if you make a great decision, if you invest in a great thing that has great returns early on, that can make a huge difference in the long run. Well, that's it for number 5. If you're enjoying these strategies, I have a whole playlist of them. I'd recommend going back and watching through the list and just making sure that you're not missing something that you could easily be doing that might take your investing to the next level. Till next time, have a great day.